Competition in the entertainment world is fierce, and we aren't talking about celebrities. Disney, Netflix, Pandora, Apple, and Sling TV have all been making headlines. We all love a good thriller, but probably not when it comes to the outcome of your stock portfolio. Here to explain what to make of all the announcements is Andriy from TD Asset Management. Thank you very much for being here.
Good to be here.
So we've heard a lot in terms of recent headlines, and it's hard not to get distracted. What do you make of all the noise?
Indeed, there have been a lot of changes recently, and the key driving force behind all of those events is a disruption from the internet. In the old distribution model, content providers such as Universal, for example, would make a movie and would sell it to a TV network that would combine it with other content into a package that we know as a TV channel. And the next step, cable provider, for example, Comcast, would take hundreds of TV channels, would package them together into bundles, and would sell it to the end consumers. In the new distribution model, internet enables companies like Universal to go directly to the end consumer and sell content through online web-based offering or through an app. And the recent announcement from Disney that they will launch ESPN and Disney online video platform is a step in that direction.
Now, when you talk about online platforms and apps, this doesn't sound new, but the conversation has definitely heated up. So how have the stocks reacted? Has this already impacted them? Are we starting to see a bit of an impact?
We should keep in mind that media is a very broad sector. It includes broadcasters and movie studios, as well as publishers and cable companies. So if we just stay with broadcasters and movies for a moment, I have a chart here that shows that while S&P is up about 8% so far this year, movies and broadcasters are roughly flat. Earlier in the year, they actually outperformed relative to the market, but once first quarter results were announced, there were concerns about accelerating subscriber losses and weak advertising revenue. Later during the year, in late July, the stocks went up on excitement about M&A in the space because we saw Discovery acquire Scripps Networks. However, when second quarter results were announced in early August, the stocks went down again because we saw a confirmation of subscriber losses continuing and accelerating from 2% to 3%. And advertising revenue also continues to be weak, and a number of companies reported advertising revenue declining between 2 to 8% year on year.
Now, you mentioned the spike in your chart when we talk about M&A activity and how that creates excitement. Why? Why does that happen?
Well, I believe that disruption in this space will drive more consolidation in this space, and M&A usually implies a premium for the target, and that catches attention. However, I'm cautious on M&A in this space because it creates value in the short term through cost cuts and higher negotiating power, but in the long term, putting two weak or okay players together doesn't necessarily create a winner in face of all the disruption that we're seeing. I believe that key differentiator is content, and especially high quality content, as not all content will win. Probably all of us had this experience where we were watching TV and we were flipping through hundreds of channels, and it seems like there's nothing to watch. The old distribution system forced, in a way, consumers to take bundles that included a lot of content that people were not interested in watching. In the new distribution model, there is a trend that consumers want to have access to online, on-demand video, and they don't want to pay for content that they're not interested in.
But it's not only content, right? Because when you and I were chatting, you mentioned it's three parts. It's content, it's convenience, and it's price. So when you take a look at the market as a whole and you look at the big players, which names are you most excited about or are you most enthusiastic about right now?
Well, first of all, I should say that I'm cautious on the space overall because of the disruption and losses in consumers and weak advertising revenue. Long-term investors should keep in mind that this is a very cyclical industry. In the last recession, the stocks underperformed relative to the market, and broadcasters and movies dropped by over 60% since the peak in 2007. Also, if you look at advertising, that's another area that was critical to pay TV ecosystem. But now it's also being disrupted by the internet as advertising budgets are shifting online to Google and Facebook. In terms of specific names, I believe that Netflix is one potential winner in the long term because the company initiated the disruption 10 years ago and now has over 100 million subscribers. The company built a very strong brand and large-scale distribution platform, and now they're investing in their own content. It is one of the most shorted stocks out there due to their focus on growth rather than maximizing profits. In terms of traditional media, I believe that Disney is a potential candidate to be a winner as well. Disney has a very strong content portfolio for families and children, and recently they decided to build their own distribution platforms for online video, which can position the company to benefit from the cyclical trend and disruption in the long term. So overall, I would say that companies that have high quality content and strong brands and large-scale distribution platforms will be potential winners.
Thank you very much.
Thank you.
We're going to have Andriy back on our Top of the Charts show, where he's going to do a deep dive on the 3 factors that he says can separate the winners and losers in this space.